Well, it's 12 o'clock, high noon in Kansas City, so I think it's time to start our Ask Me Anything webinar. Today's going to be kind of free and easy. I'm not going to try to take up all the time yapping at you guys. I want to give you guys the opportunity to ask the questions that you are interested in. But before we get into the questions, I think I'll do just a little bit of an overview about Forex, because I know that a lot of people are really interested in Forex, but they just can't figure out how it works, right? So we're going to talk about that. Now, this is just a Forex chart. This is a chart that is not in a MetaTrader trading platform. It's in a different charting program that I use, but a Forex chart is the same no matter if you're using it in a MetaTrader or if you're using it in another software program like I am doing. But the thing about Forex charts, no matter what time frame the charts are, no matter what currency pair we're talking about, Forex charts can only do two things. Okay, they can move up and they can move down. Now, the thing is, when Forex prices move, they do not move in a straight line. So the price will go up and down while it's moving up or down. Okay? And this is what makes Forex trading so difficult, right? Because a lot of people who have, especially people who have come from a stock trading environment, they're more accustomed to prices that move on a continuum up until they move on a continuum down, right? Forex doesn't do that. It's always this chunky movement up or chunky movement down. So the reason for that is because when you're dealing with a stock, you're dealing with one thing, right? You're dealing with the Apple stock, or you're dealing with the HP stock, or whatever it is, right? And so when stocks get on a momentum, they'll have a little bit of chunkiness to them, but they'll pretty much go up or down for extended periods of time. But with Forex, what happens is we're not dealing with just one entity. We're always dealing with a pair of things, right? Like in this case, we're trading the AUD-USD currency pair. And so what we have is we have essentially the two complete economies represented. We have the Australian dollar and we have the US dollar. Now, in this case, the AUD is what is called the base currency, and the USD is called the quote currency in this currency pair. Now, if the base currency is gaining strength over the quote currency, the pair price will be moving up. And if the USD currency is gaining strength over the Australian dollar, the pair will be moving down. Okay? But what it really is, it's a tug of war all the time between two economies, right? And when they're pitted against each other, as in the case with the AUD-USD, then what it is, it's really a back and forth, like a game of tug of war, because the Australian dollar will be saying, oh, good things are happening to us. We're gaining strength over the US dollar, right? And the price will be moving up. And then the US dollar will have something good happen and it'll say, oh, we need to gain strength over the AUD currency and the AUD economy, because good things are happening to us right now, right? So what it is, I like to tell people that one way to kind of look at Forex in your mind's eye, you can't see it on the charts, but if we were to take this chart and literally rotate the whole chart 90 degrees counterclockwise, what we'd have is back and forth bars, not up and down bars, right? Because the thing is, that's really more what would be applicable if the chart was going to be representative of what's really happening. And when the price would move left, that would be kind of like having the Australian dollar gaining strength, and when the price moved right, it would be like having the US dollar gaining strength. Okay, so you have to always remember that with currency trading, you're always talking about two issues at one time. And of course, there's all of the things that can affect either one of these currencies, right? And so what affects a currency price can be extremely varied. You can have things like economic news events. You can have political power structure, situations where there's conflict politically. You can have natural disasters. Those can affect currency pairs because they can affect a whole economy, like in Japan a few years ago when they had that big tsunami. Well, that affected the JPY economy, which affected the JPY currency pairs, because it affected how the Japanese economy was struggling against other currencies in the world. So to really be a good Forex trader, you have to understand that there's a lot more involved in it than just technical indicators on charts, right? Because we all like to use technical indicators, but technical indicators are just that. They're technical. And what that means is that essentially all technical indicators that you can put on a chart are nothing more than some manipulation of moving averages, right? And so I'm sure you're all aware with a moving average, right? Because what a moving average does is it takes the last number of bars, depending on the length of the moving average that you want to use, and it figures out, okay, what was the average price in the last 10 bars or 50 bars or 200 bars, whatever you plug into the formula, right? But when it comes right down to it, there's probably 280 different technical indicators available for people to put on charts. And so like on this chart, for example, if I go to studies and tell it that I want to add a study, well, here we go. There are literally dozens of indicators in each one of these tabs. And every single one of them is a different formulation of moving averages in some way, shape, or form. That's all they are. Now, the other problem is that technical indicators are by their very nature historical, because you can't have an indicator that's going to read what's going to happen tomorrow, right, or the next day. Now, some indicators, like the Ichimoku cloud, will project what they think will happen in the future, but they're just projecting what they think will happen based on what has happened, right? So the thing is, if any one of these technical indicators actually worked, there wouldn't be a need for the other 279 of them. Okay, so The thing is, a lot of people, they put all of their hopes and dreams in sticking a couple of technical indicators on a chart, right? But the fact of the matter is, you have to remember that if any one of those technical indicators worked, there would only be one in the list because none of them work. That's why people keep developing more of them, right? Everybody and their brother has a technical indicator, right? And they all work to some degree, or they wouldn't be a big enough deal to be on the list. But if any one of them worked every time, the list wouldn't need to be more than one item long, right? So that's what you have to remember, because technical indicators are measuring essentially what has happened, and then some of them are trying to project what will happen. But what actually causes the moves in Forex prices is not the technical indicators, it's the fundamental things that happen. And the fundamental indicators are the things like the economic news events and political things and, natural disasters, things like that. So if you wanted to always be aware of what's happening fundamentally, there are a couple of really good websites that you can go to. The first one is Forex Factory, and forexfactory.com is a website that offers a lot of different things for Forex traders. Most of the stuff they offer isn't really much help. They have forums where you can get involved in conversations about different situations or maybe different trades or whatever. They have a tab called Trades where people will post trades that they have made, right? And the thing is, if these people were that great at picking trades, you wouldn't see stuff like this. Okay, oops, missed again, took a loss. A lot of them, they'll be right quite a few times, whatever. But, there are things like this out here. But the other thing they have is they have news. So if you want to go see what's happening in Forex news at any given moment in time, you can go out and read the most current news articles about Forex issues. But the reason why I love Forex Factory is because they have a calendar that will essentially tell you when to expect a lot of the fundamental events that will impact the Forex market, right? And when you join Forex Factory, you can essentially create an account for yourself at Forex Factory. And when you do that, you can put this calendar in the same time zone that you are in, so that when you're seeing the time on the calendar, you'll know that that's your local time, right? And so I have mine set up for Central Time, US, right? So it's showing me that at 10 o'clock on Sunday night, that'll be this coming Sunday, that the Japanese currency, right, is going to be having a speech by essentially the guy who is the equivalent of their Fed chair, okay? And so when you know that these events are going to happen, and there's all kinds of them, there's GDP reports, trade balance reports, import prices, reports. There's all kinds of things, that economic reports that happen all week. And on this side, they give you what the previous month, if it's a situation that has numbers involved, speeches don't. But if it's a situation where there are numbers, it tells you what the numbers were last month or the last time that the report was generated. It tells you the forecast. And the forecast is what is expected to happen. So on Monday evening at 6:50 p.m., this Japanese SPPI report is projected to come out at 1.2%, right? Last month it was 1.1. Now, when these events actually happen, what will happen is the calendar will update and it will give you the actual number of what the number came in, right? And the difference often between the actual number that comes in and the forecasted number, when those two things are different, depending on how different they are, this is the kind of thing that causes Forex prices to move. So if we look at the calendar from last week, see, we had the previous month, we had the forecast, and then throughout the week, as these events happened, the actual numbers were posted. Okay, and in this case right here, with the Japanese preliminary GDP, the number came out a lot better than expected, right? Because they were thinking that it was going to come in at negative 0.1%, when in fact it came in at 0.5%, a 0.5%, to the positive. So this would have been an event that at 6:50 last Sunday might have moved the market in favor of the Japanese yen, maybe 20, 25 pips, right? So that's kind of what happens. Now we can go and double check and see what actually happened if we want to. Let's do. This happened right before 7 p.m. in Kansas City time last Sunday. So let's go back and look at our chart. And so this is a daily chart. We need to bring this down to probably being about a 15-minute chart. And then we need to back up to last Sunday and then look for what did we say, right before 7 p.m. And so that,
Mindy?
yes?
Mindy, you're not on a Japanese pair.
Oh, thank you, Alan. Okay, one thing I have to tell you guys is I am actually legally blind. Thank you, Alan. And so sometimes I get a little ahead of myself because a lot of this stuff I can't actually see it. And so that's what happens. Thank you, Alan. So anyway, Alan and some other people, they keep me in check, okay? But yeah, my vision problems are one of the reasons I'm teaching these classes, to tell you the truth, because I think that I'm at the point where I'm not going to be able to teach Forex much longer, so I'm trying to get some knowledge imparted to you guys while I still can. Okay, with a little help from my friends. Okay, so anyway, what we're looking at is 6:50. That would be right before 7 p.m. 7 p.m. in this time frame is 1800 o'clock. So we'll look right here, and it didn't have much of a wiggle. See, between 1730 and 1800 o'clock. So even though it came out good, that one did, for the JPY pair, we would have expected in this case the JPY pair to drop. Now my guess is here, right in through here, this was probably people trading into that news event, thinking, yeah, it's probably going to come out better, so we're going to go put some bets that the JPY will gain strength a little bit, but it didn't pan out. It just kind of sat there and went sideways, and then what happened was the US dollar, the strength in the US dollar took back over. Okay, so, and then later that night, look what happened. It fell back down. Here's the thing. It doesn't matter what time frame of a chart that you're looking at. This is a 15-minute chart. We could look at a 1-hour chart. We could look at a daily chart. We could look at a monthly chart. It doesn't matter. Forex prices always move up and down while they're moving up or while they're moving down. Okay, so doesn't matter what time frame you're looking at. Okay, so anyway, this Forex calendar at Forex Factory is a really good one. Now you'll notice that they have 3 different kinds of news events. They have red events, orange events, and yellow events. The yellow events are low impact things. So a low impact news event is usually not going to move the market a whole lot, right? Usually 25 pips or less, okay? An orange event has the potential to move the market somewhere between 25 and maybe 100 pips at the most, right? So these would be mid-level news events, right? Now, red events, on the other hand, are the ones that you really want to watch out for, because a red event will have the ability to move the market in excess of 100 pips. It doesn't mean it will move the market 100 pips, but it has the potential to. Okay, so you always want to know what's coming up, because let's say that you're just kind of sitting here on a Monday evening wanting to look for some trades, and you see a good idea to go into a trade maybe at 8:15 p.m. and it involves the AUD. Well, the thing is, right before you go in your trade, you might want to check and see if there's something coming up on the news events calendar that could possibly take that Forex price and move it 100 pips or more right after you go into that trade. And you might want to hold off a little longer before you go into a trade, because we don't know if this news event's going to move it 100 pips up, 100 pips down, or just not at all, right? But you wouldn't want to take a trade a couple of minutes before this news event. You'd want to hold off, see what happened on that news event, and then if there was a big move on that news event, that might very well change the idea that you had for your trade. And it might keep you out of being in a trade that within a few minutes could be really ugly, okay? Now, another good website to look for is called Forex Live. Oh, great. They're probably down for maintenance or something, wouldn't you know? But Forex Live is actually a great website. They have a staff of people, here we go, that work 24 hours a day when the market's opened, okay? And it looks like they actually work on Saturday too. But what they do is they spend their time doing nothing. These people don't trade that work for them, doing nothing but scouring world news, and they have a lot of contacts in the really big banks and forex brokerages and things like that, and they're gonna try to keep you filled in on what's going on with forex issues all over the world. And this is a wonderful website. It also is free. This Forex Factory one, you can make an account over here for yourself. It doesn't cost anything, right? And so there's no reason not to have Forex Factory and Forex Live added to your favorites bar, in your web browser, so that you can get to these two sites really quickly, because they're a lot of help when you're trying to trade Forex. Okay, now the other site that you should have saved is my website, right? MindyYost.com, right? Because I have a lot of things that are really helpful for you. I have a Forex margin calculator that you can access in a moment's notice, and this is a really good thing. Now, what happened here is that the widget thing that I had installed on my website went sour. I tried to reinstall that today, and there's a problem with the snippet. So what I did is I went ahead and posted a link for you where you can go over to investing.com and get to their margin calculator quick as a wink. Okay, because this margin calculator is really important, because as you know, every time you make a trade, you have to put up a deposit, right, to be in that trade. And if you don't know how much the deposit's going to be, then you might be making a trade that's way too big for your account, right? So the way that you would use this margin calculator, the account currency, that's the currency that your home currency is. Okay, so for me, that's USD. You know, if some of you are somewhere else in the world, it might be the Canadian dollar, it might be the euro, might be the yen, whatever. So this is your home currency. And then you pick the pair that you're interested in. And so right now it's set up for Euro USD, but you can find any currency that you would want to trade in this list. And then it has the current conversion rate, and then it asks the margin ratio. Okay, now depending on what broker you're trading with, your margin ratio is essentially your leverage ratio. Okay, so I trade with a 500 to 1 leverage, which isn't even on the list here. And so I'll just do 400 to 1, because there's not much difference between a 400 to 1 leverage and a 500 to 1 leverage, right? But if you're trading with a broker in the United States, then you might have to come all the way down to a 50 to 1 leverage. And now, if you're trading in the UK, some of the pairs only have like a 30 or 25%, right? The lower the number, the more you're going to have to pay as a deposit to be in the trade. So let's go to the 400 to 1. And now when it says trade size, what you have to remember is that a full lot of any currency is 100,000, right? That is one full lot of any currency pair. And it doesn't mean dollars, it means 100,000 units of the base currency. Okay, so if you were doing a one lot trade, you would key in 100,000. So now let's calculate. And I did something wrong. I think this doesn't want us to use the comma. There we go. So if I wanted to do a one lot trade and I'm using 400 to 1 leverage, my deposit margin would be $280.27. That's how much I would have to have taken out of my account temporarily while I was in this trade. Okay, let's watch how this differs if you were trading in the United States. Okay, if you were trading in the United States where you can only have a 50 to 1 leverage, let's calculate that. And what we see is that it would be the same trade, but your margin requirement for that trade would be $2,242. Huge difference, right? If you had a $10,000 account and you made one lot trade in Euro USD in the United States, you just had almost 25% of your account pulled off temporarily as a deposit for being in that trade. Whereas if you're trading overseas with a broker that offers higher leverage and you have 400 to 1 leverage, of your $10,000, you've only had 280 pulled off as a margin requirement. Okay, and it's really important that you have a feel for about how much the margin requirement is going to be on every trade you make, right? Now, as time goes by and the more familiar you get with Forex trading, you will just kind of know these numbers instinctively, right? Like, I don't really have to look them up much anymore because I've been doing this for so long, and so I just kind of know when I take my trades what I'm signing up for. But until you get familiar with this, it's a good idea to come over and do the margin calculator every time you take a trade, okay? So that you know how much money is being drawn out of your account. It's not that you're spending the money, but while you're in the trade, this amount of money is going to be withheld from your account. So you can't use this $280 to manage negative PL with, because it's already tied up being as part of your margin deposit. Now, if you were going to do a 1 mini lot trade, 1 mini lot trades are essentially 1/10 of a lot. So 1/10 of 100,000 units is 10,000 units, right? So you type in 10,000 if you were doing 1 mini lot, and you calculate that, and we see that it's $28.02 essentially. Rounded off, it'd be $28.03, right? But what if you were doing a 4 mini lot trade? Well, you just go in here and type in 40,000, right? That would be the equivalent of a 4 mini lot trade, and that would be $112. Okay, so anyway, it's real important that you get familiar with a margin calculator. This is a good one. Like I said, until recently I had a link where that would just show up right here, and unfortunately, I don't know, it's goofed up, but you can get to it by clicking this link from my website, okay? And then when you want to go back to my home page, you just go up there, and I post videos usually at least once a week, sometimes more often, and so you never know. Now, on my website, after this afternoon, after this meeting is over, this is going to come off, and so whatever is most current about what's happening, or the most recent video that I've posted to YouTube or whatever, it'll be right up here at the top. But you can always get to the margin calculator right here. Okay, now the other thing too, I like to help Forex traders as much as I can, right? So here's my email address right here. So if you have a question, you can email me anytime you want to. You can either copy this right here, whoops, and paste that into your email message, or if you want an even more direct link, I now have this email me button right here. So if you don't want to use, this, if it's too hard to copy my name from there and paste it in an email, just click on this email me link, and what that's going to do, it's going to open a message where you can tell me who you are and tell me your email address so I can answer you, and type in your message and just send it to me without ever leaving my website. Okay, so I just want you all to know that you're welcome to email me anytime you want to. Now, depending on the time of the day or night, I'm not guaranteeing that I'll answer you instantly, right? Because I do mentoring, right, where I teach students my particular strategies plus everything else that they need to know about Forex, right? And when I'm with my students, I do not even look at my email. But as as the day progresses, I will check my email, usually at least once every hour or two. And if it's a situation where I have time to answer your question, I will answer your questions. Okay? But now the thing is, if you really do not understand Forex strategy, I'll just do a little plug right now and then I'll shut up about it. Okay? But if you really need help figuring out strategy for Forex, my monthly subscription service to my mentoring program gives you 24-hour access to me at any time when the Forex market is open, where you can come into a go-to-meeting window like this one and you can just literally talk to me. Because on my student line, that line is open for anyone, any of my students, to just come online and start talking and say, hey, Mindy, I need help, or I need this, or I need that, or what do I do about this or that? Okay. Now, if you want to try my mentoring program on a month-to-month basis, you can do that by clicking this link right here. Okay. Now, when you click this link, the fee for my mentoring program is $500 a month, but you can cancel it anytime you want to. So by clicking this link, you're not making a long-term commitment. You can't cancel it mid-month, but as long as you cancel it before the next monthly billing date, you can cancel it anytime you want to. Okay? Now, the thing is, when I work with students, most of the time it takes my students right at a year, some a little longer, some a little less, but to really turn into masterful Forex traders takes about a year. So if you'd like to save money and you're committed to learning Forex in a strategy that's going to help you have the best chance of being successful, you can sign up for a 1-year subscription and you'll actually save $1,000, because the 1-year subscription is $5,000, a one-time fee, right? But it's cheaper than buying a year of mentoring month by month, because this would be $6,000 a year. Okay. Now, Alan, I'm going to ask you to unmute if you're still there. And I'm going to have you give a testimony on how long you think it takes somebody to truly learn my strategy and to turn into a profitable Forex trader. Do you want to say a few words since you're here today?
Yeah, I'll say a few words. Before I became a student of Mindy's, I was interested in Forex, and I was completely confused. I was going website to website to website. I was struck with analysis paralysis kind of thing. There were so many indicators. There were so many brokers. There were so many trading platforms. There was so much of everything. I didn't understand, the pairs. I was adrift, literally. So being a student of Mindy's puts everything into a framework. It takes all those variables in all those directions and throws out the junk and the noise of everyone else, and puts you into a framework from which you can start to see things more clearly, much more clearly, and understanding the whole the whole strategy, the whole approach, the bigger picture, so that you, on a daily basis, you can see how the price action fits into the bigger picture and what you're trying to accomplish. Um, I don't know how much more to say. If I've come to learn that when I sit down at my computer, the most important thing is for me not to lose money, and you basically can have an approach that I'm going to sit down, try and make as much money as I can. I'm going to trade, 3 lots, and and all it has to do is go up 10 pips, and I'll make so much money, and then you lose all your money. It's like the racetrack, or it can be Forex, like the racetrack, or like gambling. But Mindy's taken that aspect of the gambling aspect out of trading, if you follow her strategy, and if you learn the whole deal about Forex, and that's what Mindy has to teach. Okay, I
But
don't
it
really want to blather on.
but it took you about a year, though, right? Before you really put all the pieces of the strategy together, right?
For me, yes, it took a year, a little. Actually, it took me a little longer, because I didn't have much experience, and I did keep flitting around a little bit after I met Mindy, even after I became her student, to see what other people were saying and doing, and how that compared with what Mindy was saying and doing. And that took up a couple of months, until I came back to realize that Mindy's approach is the most that has the best design, has the best plan, has the best parameters, has, you can see visually where you're at in today, and this hour and this minute, in comparison to the bigger picture. So it's actually taken me. I was a poor student, because I didn't show up for 3 or 4 months while I was trying to check out to see if somebody else had something better. And I eventually, after reading and studying a couple other approaches, came back to Mindy and said, yeah, now a lot of the things that you've been saying make a lot more sense to me. And the things that you're teaching make a lot more sense to me now that I've studied some of these other guys that, are teaching things. So actually, it's taken me a little more than a year, but it's been so worth the money to me. I would have lost so much more money trading Forex, and I haven't lost money now. I mean, at this point, I don't lose money. Sometimes I make a little, sometimes I make a little more, but I'm still a beginner in my mind. But if you're looking at Mindy's screen right now, it says stop taking Forex losses. And I don't take Forex losses. So I don't know, is that's anything else you
No.
have a question, or does anybody have a question they want to ask me?
If you have a question directly for Alan, you can open your mic and ask him. That looks like everybody's pretty quiet today. Well, thank you, Alan. I appreciate your testimony. I didn't know you were going to be here today, so thanks for being here.
Okay.
But anyway, what Alan is saying is that for him, it was a valuable experience to just buy the annual subscription and have it be over with and not have to worry about the monthly payments being debited. But the thing is, if you want to try my mentoring service for a month or two, I'm happy to have you come on board on a monthly subscription. And if you have to or want to cancel at any point, there's no harm, no foul, no hard feelings. Okay, so that's my only advertisement today for my mentoring service. But here's the gist of what I teach in my mentoring service. First of all, I try to unteach you all the things that you've probably learned about Forex, right? Because most of those things are not correct. And some of the biggest fallacies of Forex is that the trend is your friend, okay? Most people are going to tell you the trend is your friend, and when you see a trend, you need to hop on it and follow that trend. But here's the problem with that and why that's not true. The trend is only your friend if you can get into it before it's evident that it's a trend. Because most of the time, not this situation, but most of the time, by the time a trend is evident, it's over. And so what's happening, the way most trend traders trade, what happens is they're looking for moves where they've had, 2 or 3 bars of higher highs and higher lows, and then they wait for that confirmation bar and they're doing their buy right about the time that the price turns around and goes the other way, right? And then they're going, oh, geez, I got stopped out of that, but now it's obvious it's going down. So then they're doing a sell right about here because they can see the trend. Obviously, they say it's going down. So they're doing a sell right in here. And what happens? Well, the price moves up enough to stop them out of that sell, for 10 or 20, 30 pips. And then what happens? Now the price goes right back down. But the thing is, most trend traders are doing it completely wrong, because what's happening is they're going into buys right before the price turns down, and then they're stopping out for a loss, and then they're saying, okay, then I'll do a sell. And they're doing a sell right before the price goes up enough to stop them out, and they're chasing what they think is the trend, and the wiggles, right? Forex goes up and down while it goes up and while it goes down, right? What happens is all these little wiggles make them lose money over and over and over again, right? So what I teach, which is different, is I teach a system that's based on a mathematical calculation that I developed 20 years ago. And that calculation shows us and tells us when high is high enough to be a place to put a sell, and when low is low enough to be a place to put a buy. Okay? So that's the difference. I am not a trend trader. I'm also not a counter trend trader. What I am is I take advantage of overreactive price action. Okay? Now, overreactive price action can happen during a trend, right? So just because the price is trending up, that doesn't mean that we can't make money off of sells along the way, and buys, right? Buys into the trend and sells counter to the trend. But in both situations, what we're looking for is overreactive price action and knowing when that overreaction is overreacted enough to be the entry point. So that's what I teach you in my mentoring program, right? But today we want to get even a little more basic. We don't really want to spend the day talking about strategy, right? Because I want to answer the questions that you guys have just about the Forex market. But one thing that you have to remember about opening a Forex account is that funds that you put in your Forex account are funds that are at risk no matter what, because there are so many things about Forex that we cannot control. Okay? There's broker risk. You know, the broker you're using might turn out to be a scam operation and run away with all of your money. Now, everybody says, well, that's going to happen with foreign brokers, but not necessarily. I have lost more money with U.S. brokers over the 20 years I've traded, and the U.S. regulators did nothing to protect me or help me get my money back. So I've had U.S. brokers that have been big fat cheaters, right? I've also had some foreign brokers halfway around the world that were some of the best Forex brokers I have ever had. And I've never actually had a situation where I got scammed by a foreign broker. But I sure did get scammed by a U.S. broker, right? So the thing is, when people tell you that if a broker is not regulated, then they're automatically a bad broker, that's simply not true. It can be true, it might be true, but it's not necessarily a given that it is true. Okay? And so that's just one element of the risk. You can have country risk, where maybe the economy of an entire country collapses, and that changes the picture of the currency status of that country between all the other currency that it trades against. You know, we had a situation, I don't know, 3 or 4 years ago now, with the Swiss franc. The Swiss franc tried to recalculate, their currency value, and it got out of hand. And the CHF pairs moved over 3,000 pips in about 20 minutes. And it literally shut down the entire Forex market for about a day. And hundreds of thousands of traders lost everything in that deal. And about 30% of the brokers worldwide went out of business that day. They went bankrupt. So, that's a country risk. That's something that no one can control. You have risk like natural disasters, a tsunami or a volcano or something like that can happen that can totally make Forex pair prices go off the charts and go crazy. So there's lots of ways to lose money at Forex, but the biggest way that most people lose money is their own trading. Okay, 99% of the people who lose money in Forex lose money because of the trades that they purposely take, and they're taking bad trades. Those trades lose money, and eventually the person loses all of the money in their Forex account. So when you read the disclaimers, which you will find everywhere in Forex, you have to remember that the funds that you put in your Forex account are funds that are inherently at risk, even if you are the best trader in the world. Okay? It doesn't mean that you're guaranteed to lose your money. It just means that even me, and I think I'm probably one of the best traders in the world, even I could lose money at Forex through no fault of my own, you know. But the thing is, you've got to understand that the money that you put in your Forex account is inherently at risk. But does that mean that we're not going to put money in Forex? Nope. That's not what it means. Because you'll never make money in Forex if you don't have any money in a Forex account, right? So it's a choice that you have to make, but you should never put money in your Forex account if you lost that money, if that would change your lifestyle, okay? So that we don't put next month's rent into a Forex account, right? But when we have extra money that we know that we're not going to need for rent or food or things like that, those are the funds that you put in your Forex account, okay? But if losing that money would change your lifestyle, do not put money in the Forex account. But if it's money that you have access to, that you can invest different ways, that's funds that you might want to put a portion of that into Forex. Because the fact of the matter is, you can make more money in Forex proportionally than any other investment that you can make anywhere. And the reason for that is because of something called leverage, okay? Because what leverage is the ability to control a vastly larger pool of funds than what you have paid for, right, in your deposit on your trade, okay? So let's put it this way. Let's just do a little diagram here. And let's make a rectangle, okay? And let's say that this rectangle represents one full lot of a currency pair, right? Well, one full lot of a currency pair is 100,000 units of the base currency. So this red box would represent $100,000, okay? Now, if you're working without leverage, if you wanted to buy one lot of USDJPY, you would have to pay $100,000, right? Well, if you're in the United States and you're using a 50-to-1 leverage, that means that for every $1 you put up for your trade, the broker's going to lend you 50 more. So you only have to put up 1/50th of the price of the $100,000 to be in the trade. So 1/50th of this $100,000 would be about $2,000. So that would mean that in the United States, you would have to pay about 1/50th of the price of this box. And that might look something like, well, this, or it might look something like this, but it would be essentially 1/50th. So instead of $100,000, you'd be putting up $2,000. Now, if you are trading with a foreign broker that gives you 400-to-1 or 500-to-1 leverage, that would mean that for every dollar you put up as margin to control this $100,000 block of money, you know, every $1 you put up, the broker's going to loan you 500 more, right? So you would only have to put up 1/500th of the value to control the whole block. So that might look something more like a box about this big, right? So for The higher the leverage, the more money you can control, right, for the least amount of money. Okay? So this is the power of leverage. And this is why I can go out there and buy one lot of USD JPY, and my broker only charges me like $250 to be in that trade, but I am controlling 100,000 US dollars, right? But since I'm controlling the 100,000 US dollars, that means that I get the benefit if the market moves in a way where I'm making money. But it also means that I have the entire downside risk if that trade goes against me. Okay? So you've heard, I'm sure, about pip value, right? Well, the way Forex prices move is that each pip is worth 1/100th of a penny. Okay? So 1 pip equals 1/100th of 1 penny. And so now you're saying, oh God, how does anybody make any money? Well, if 1/100th of a penny is how much 1 pip is worth, you have to understand that that 1/100th of a penny is being multiplied by 100,000 units of the currency, right? So what that means is that 1 pip of a 1 lot trade equals about $10, right? Because it's 1/100th of a penny times 100,000, and that equals $10. So if I'm in a 1 lot trade, whoops, why is this not going where I wanted it to? Let's try putting it back here. There. So if I'm in this trade and it moves 1 pip in my favor, 1/100th of a penny, I just made $10. That's pretty good, isn't it? Because how does something move 1/100th of a penny? Well, Forex prices do, because that is the increment of movement in a USD pair. It's 1/100th of a penny. So if this trade moved from, let's say here, let's go back to this other tool. Let's say that I went into a sell right here at 110.08, okay? And the price fell all the way down here to 109.45. Well, that would mean that I just made 65 plus 8 is 73 pips, right? Well, if I just made 73 pips and each pip is worth $10, I just made $780, right? That's how people make money in Forex. That'd be a great trade. But what would happen if I had done a buy here and the price went down to here? As the trader controlling this $100,000 block of this pair, I am fully responsible for any losses that happen in that trade. So I would be responsible to cough up $780, right? So you reap the reward when you're right, but you also suffer the entire pain of being wrong, right? But that's called leverage. But to be in this trade, I didn't have to spend $100,000 to be in the trade. I had to spend $200. And if I was trading in the United States, I would have had to pay $2,000. But either way, I'm going to reap the reward if I'm correct, and I'm going to suffer the pain of losing if I am wrong about my trade. Okay, so that's called leverage. That's how people make huge amount of money in Forex. Because I don't know any other investment in the world where a price can move, a penny, and you can make $1,000 on that trade, right? So this is the beauty of Forex, but it's also why so many people lose money, because they forget that they're also responsible for the entire value of the $100,000 block of money when it's losing value. Okay? So this is something that's really, really important to understand. Okay? Now, the other thing about Forex is that most people, when they trade, they go into Forex thinking, my goal today is to make $400. Or my goal today is to close 50 pips profitably, right? Whatever. Either way, that's the wrong mindset to go into the Forex market with. The way that you should have as a correct mindset is that you should say every day when you start trading, what is my goal today? Is my goal to make a lot of money or to make X amount of money? Or is my goal today to not lose money? Okay? Because who wins bigger? A guy who took a chance and got in a bad trade and lost a bunch of money, or the guy that sat it out waiting for the good opportunity that didn't come, so he didn't go into a trade at all, and at the end of the day he still has all of his funds intact. Okay? So you have to remember, every day when you sit down to trade Forex, you ask yourself, is it more important for me to make money, or is it more important for me not to lose money? And if your mindset is that the most important thing is to not lose money, then you're going at it with the right attitude. Because some days the Forex market will offer all kinds of trade opportunities, and you can make a ton of money, and it's easy. And other days you can sit there all day, watch for trades, not find any good entry points. But if you haven't gotten frustrated and taken bad trades, at the end of the day you still have your money. You still can live to trade another day, right? So the thing about Forex is you want to be patient with your trading. You want to watch for situations that are really good trading opportunities, because you'll know them when you see them. But anytime you're asking yourself, gee, should I do this? Would this be a good place for a buy or a sell? And if you have to ask yourself that question, should I do this? That is your answer. No, you shouldn't. But when it's obvious, you won't ask yourself, should I do this? You're going to be saying, oh, here's where I want to do a sell, or here's where I want to do a buy. And it'll be obvious. You won't be asking yourself that nagging question, should I not, should I wait? When you're tentative, that is your answer, and it's telling you, do not take that trade. Okay? So that's really the most important thing about it. But you also have to remember that when you put money in your Forex account, The reason you're putting money into the Forex account is to use this money to make more money, to make other money, right? And the way we do that is by spending part of this money on margin to be in trades. And sometimes we have to use part of this money to cover negative PL in trades that are going ugly. Because what do we know about Forex charts? You know what? They go up and they go down. That's the only two things they can do. And they always go back and forth. They'll go up for a while, they'll go down for a while, but they never just go flat out sideways forever. They never go straight up forever. They never go straight down forever. So, no matter where you put a Forex trade, let's just say that you put a Forex trade in right here. What we're going to do is we'll just put a price line in. There. And it's a blue line, so we'll say, okay, it's a buy trade, right? But it could just as very well be a red line. But what happens here? If we went into a buy here, oh good, we made money. If we went into a buy here, uh-oh, we're losing money, right? But what's going to happen? If we wait it out, we're going to be right back in, oh, now my trade's profitable, right? If we went into another buy in here, what would happen? Uh-oh, it went the wrong way, but what happened? Oh, it's fine, right? If we went into a buy here, oh gosh, here we go, losing money. But you see, the whole trick to Forex trading is that if you wait long enough, every single trade you take is going to be profitable. It's just a matter of when, right? And how much longer is it going to be before it's profitable again? Forex is nothing about time and money. Having enough time to wait it out until your trade becomes profitable, and having enough money to ride it out while it's negative, right? So the thing is, though, it doesn't matter where you put a trade on any given day, and I'm not telling you to go slop in trades, that's not what I'm saying. But what I am saying is that no matter where you put a trade, sooner or later your trade will be profitable. It's just sometimes when is later. If this was a sell trade you'd put in, we're going to be saying, oh my gosh, I'm dying here, right? But what I do is I teach you how to hedge your trades so that you don't care how far this goes up. Sooner or later, you know that it's going to come back down. And so that's all you got to do is be in a position to wait it out, okay? And sometimes later takes a lot of time. But it honestly doesn't matter because every single trade is profitable sooner or later. Okay? So anyway, that's kind of the basis of what I wanted to share with you just as a very brief overview about Forex. And so now I see that there are some questions starting to come in, so let's try to answer some questions. Okay, and let's see. Erin, is Nadine's question the first one? Because I don't know if I missed any scrolling up the list.
Yeah, that's the first one.
Okay. So Nadine asks, if I deposit $10,000 with a 400 to 1 leverage, it seems that I could trade 40 lots, correct? And what would you do in this situation? Would you trade 40 lots or less so that you are not maxing out the leverage? Well, actually, yes. here's what I would do. When I put $10,000 into a trading account, what I do is I never put myself into a situation where I'm going to put all of my eggs in one basket, right? Because that's never a wise idea. Because what if you drop the basket and it breaks, right? So what I do is I have a strategy that I teach. This is part of what I teach. But what we do is we take our account of $10,000, and here, we'll just try to start writing some of this stuff down. So we have an account with $10,000. Okay? So what I do is I say, I want to be able to make at least 10 different trades at any one time, because I don't want to put all of my eggs in one basket, right? So what I'm going to do is I'm going to take my account and I'm going to essentially divide it into tenths. So what I'm going to say is that I don't want any one trade taking up more than $1,000 of the funds that I have to work with, right? So the first thing you would need to do is you would need to know your leverage, right? Because just because I have $1,000 here that I'm going to invest in one trade, that does not mean that I'm going to go to, just a sec. That does not mean that I'm going to go to the margin calculator and figure out how big of a trade that I can make for $1,000, right? Now I'm using 400 to 1 leverage, correct? So if I was going to try to figure out how big of a trade I could make and not have my margin requirement be more than $1,000, right? What I'd have to do is just start typing this as a bigger number and a bigger number, right? Now here would be 200,000. This would be a 2-lot trade. So let's calculate that. Well, that's only $560, right? So it looks to me like I could do, if I wanted to spend $1,000 on leverage, of my leverage, I could probably do somewhere around a 4-lot trade. But what if I did a 4-lot trade? If I did a 4-lot trade and that trade started going negative, if each lot has a pip value of $10, a 4-lot trade is going to cost $40 per pip that the trade is going negative, right? So what would happen to my account if I had $40 every pip going the wrong way, right? If that went 100 pips the wrong way, that would equal 40.00. So if this trade went 100 pips the wrong way, my account just spent another $4,000 on this trade, right? You don't want to do that, because how do you know that the trade that you just made is not going to go 100 pips negative? You never know for sure. But if I know that I only want to invest $1,000 in my trade, what that means is that I'm going to do a 1 mini lot trade, right? because with a 1 mini lot trade, and I'm using 1/10 of my account to manage that trade, so I'm using $1,000 to manage this trade. That means that when I enter this trade, I'm going to be spending about $20 of my $1,000, right? So I still have $980 if I'm doing a 1 mini lot trade, right, to manage this trade with. So what does that mean? What it means is that this one little mini lot trade that I made could go 980 pips the wrong way before I would have spent my whole $1,000 that I've allocated to that trade, right? Because 20 of it's on margin, and if it's going the wrong way and it's about $1 per pip, that means this trade could go 980 pips the wrong way before I would have used up this $1,000. Does that make sense? But I'm never going to let a trade go 980 pips negative, right? So what I would do if I was in this trade and then it went 100 pips negative, I would hedge the trade. Because if this was a sell trade, I would do a buy trade. If it's a buy trade, I would do a sell trade. But by hedging the trade, it doesn't matter how far the price goes up or down, because what's going to happen is that the two trades are offsetting each other. Okay, so let's say that, let's go find a place here. Maybe we should look at a daily chart. It'll be easier. Okay, so here's a situation. Let's say that we had done a buy trade right here for some reason. We thought that this had turned around, and so we did a buy trade. I'm not saying that we would have done a buy trade there. I'm just saying we're pretending. Hang on, I messed this up again. So we'll say for whatever reason we did a buy trade right there. Okay? Now, if that trade goes the wrong way, that trade went in at 113.42. So, if we duplicate this and we say, okay, at 112.42, we're going to offset that trade. That line's close enough, okay? So now this trade is going to be a sell trade. Okay? So blue line means a buy, red trade means sell. Well, if I have hedged my buy trade when it is 100 pips negative, what does that mean? It means over here that I just used another $100 of the $980 that I have to manage this trade. So we're going to go minus 100, right, equals. Now I still have $880 to manage this trade with, right? I'm still just using just this $1,000 on this trade. Okay, so now, do I care if the price goes way down here, which is 800 pips lower? No, I don't care. I have a buy trade now that is 900 pips ugly, but it doesn't matter because I have a sell trade that is 700 or 800 pips positive. The difference in my negative equity in my account is still just negative $100. Doesn't matter how big the numbers are. What matters is that you have stopped the bleeding in your account at $100, no matter how far the price goes down, right? Now, you're going to say, well, how do you get out of this mess? Well, really, Right. Well, that's pretty easy actually, because as long as you can find a good low spot someplace or a good high spot, it doesn't matter which. All you have to do is add a third trade to the mix. So let's say that we did, oh shit, a sec, sorry about that. I want to go back to this other tool. So let's say that when the price took this big dive, sorry, having a little trouble with the tools today. The price did this big dive, and let's say that we decided that since this dive was very close to this previous low, almost spot on the money, right? We thought, yeah, this is probably a good support level. So let's say that we got in somewhere down here, and we probably wouldn't get in at the very bottom, but let's say that we did get down here. Well, so I just did a new buy trade, right? As long as this buy trade goes more than 100 pips, so it went in at 1502. Let's say that the price goes up to 1702. There. The price goes up $200 here. I can use this $200 to buy my way out of this situation and not have to worry about it anymore. Because what do I have here? I have one buy trade that's worth $200. I have a sell trade that at this point is worth about $500. And I have a buy trade that's negative at this point $600. So I have two positives, a 200, a 500, that's 700, but I also have a negative that's negative 600. So what do I have? I have 100 pips profit in the combination of closing the three trades, right? Does everybody get that? So this is the power of hedging and knowing how to add another trade to get out of a bad situation. Okay, this is what I teach. These strategies actually get very complex, and that's why it takes people months to really learn them. There's a whole bunch of different strategies for getting out of situations. Okay, but this is just a very simplistic one, where you can literally get out of this bad situation where you've held this one horrifically ugly trade for maybe weeks or whatever, but an opportunity will always arise if you have hedged it properly, that you can buy your way out of that hedge and never take a loss in your Forex account, right? Everything about Forex is time and money. Having the time to wait out a situation and having enough money in your account where you don't have to worry about any one trade eating up more than you want it to. Because by buying this third trade, what did we do over here? Well, we actually used another margin requirement. So right here, we've taken another $20, which is my margin requirement to be in the new trade, off of our 880. So far, out of our entire $1,000 to manage this trade with, we still have $860 of it left, right? Now, why would I want to leave that much money in my little pot to manage this trade? Well, what happens if you goof up and you make another mistake? What happens if you decide to do a buy right here because you're looking at that and you're going, yeah, that's a good low, and oops, you were wrong, and so now you have to do another sell 100 pips lower than that to hedge that, right? then you would be now down to about what, $700, right? Because this then would become what? A red trade, a sell trade, right? But sooner or later, what's going to happen, even if you screw up 2 or 3 times, sooner or later there's going to be an opportunity to fix the entire situation. If you have this trade hedged here and then you try to fix it and your fix goes ugly and you have to hedge it here, and you keep going down the list and you have 3 or 4 levels of crap in your trade, right? All it takes is one good trade to get out of the whole mess. Okay? So anyway, that's the power of hedging and not using up too much money in any one trade. Okay? So this $1,000, 1/10 of my $10,000 account, I'm going to allow that much money to manage every single new trade that I enter. But all the rest of these trades are coming out of the portion of my account that I originally allocated right here. Does that make sense to you?
Hey, Mindy. James has a quick question about day trading with stop losses, and then Nadine has a question about sizing your trades when it comes to the EA.
Okay. Now, what is James' question again?
So James says, is it better to day trade without a stop loss?
Well, I believe that it is, because what I do is, instead of using stop losses, I think stop losses are a sure way of losing money every time. And because what happens with Forex is that if you have a stop loss on your trade, a lot of times what's going to happen is there's a thing called herd mentality, right? And you might be sitting at home all by yourself, not talking to anybody, not interacting with anybody, but you're still going to be thinking the same thing hundreds of thousands of other people are thinking at that same time, right? Because what happens when people use stop losses on their trades, generally everybody who is looking at the market is seeing the same chart, right? We're all seeing the same chart, and we see things in the chart and we say, okay, I'm going to do a buy here because I see this new trend developing, right? And then people always look at everything the same way, even though they're not talking to each other. And so they might be doing a buy here, and they might be saying, okay, I want to get 200 pips off of this trade, right? And they're looking over here and they're saying, yeah, the next high resistance area ought to be right up here about 1375. And so they're going into a buy right up in here somewhere, and they're saying, I want this buy to be 200 pips. That would be 1350, and I'm willing to I'm willing to give myself 25 pips leeway on being wrong. So they're putting their stop loss right here about 1100. And what happens? The trade's going their way, and they're going, yeah, I'm so smart. I'm the smartest guy in the room today, even though I'm the only one here, right? And everything's going their way. And the price gets up here to 1320-ish, and they're going, yeah, baby, mama needs some new shoes. Get on up here. All they're waiting for is 1350. And what happens? Oh, the price starts dropping. They go, that's okay. I know it's going my way. I know it's going to hit this 1375. So I'm just going to believe in my trade. That's what they're saying. And so what happens? Then they go out for dinner, right along in here. Okay, honey, let's go get some pizza, right? And what happens? They come back from dinner. Not only did the price go below their entry point, it hit their frickin' stop loss. So instead of having a trade that they could have had 175 pips off of when they wanted 200, they end up losing 25 or 50 or wherever they put their stop loss, right? This is why I do not ever believe in stop losses. I also believe that once you have a trade that is positive, you should have a stop on the trade, but I call them profit stops because it should be protecting profit, not ensuring loss. So when you guys see my trading accounts, you will never, ever, ever see a stop loss on my trades. Not ever. But I do use profit stops. I add stops only when my trade is profitable and only to protect profit. Does that make sense to you, James? But okay, here's what you can do instead. Instead of using a stop loss, why don't you do this instead? If you want to do a buy here, or anywhere, or a sell, whatever, instead of using a stop loss, go put a hedge 100 pips lower. If you're doing a buy, put a hedge order 100 pips lower. Or if you're doing a sell, put a hedge order 100 pips higher. And that would be for the opposite trade. And more often than not, your hedge is not going to pick up. And your trade is going to be profitable. And once it's profitable, put a profit stop on it, and then you can take off that hedge order. So, one way or another, you're going to have a winner. It's either going to hit your limit order to come out for 200 pips or whatever we decided we were looking for, or it's going to back up and take the stop out, but you're still going to make money, right? Because it's stopping you out for a profit instead of a loss. And, if that was a good place to enter once again, it might be a good place to enter again later. But you made some money this time. Could have made more. But, if you don't come out here for a profit stop, you're going to come out for a stop loss down here. Why not take some profit off the table, wait for the price to drop, and go in again? Right? So anyway, that's my what I think about stop losses. I simply don't use them. But what I do is I put orders out to hedge my trades, and I put them at 100 pips out. And if my trade's hedged, then I deal with it the way I showed you on the other example. And most of them don't hedge. In fact, just last week I had a trade that got 99 7/10 of a pip away from hedging. Literally missed picking up the hedge by 3/10 of 1 pip. And the next day I took that trade out for about a 70 pip profit. That was just last week. We were joking about it. In fact, I think no, the person is not online with us right now. That he had the exact same trade that I had. And anyway, we were laughing about that just a couple of days ago when that happened. But I told him, I said, see, I told you I didn't think it was going to pick up that hedge. But I mean, it was just literally a hair's breadth away. But it didn't pick it up, so it didn't matter, right? And the next day, the trade was not only profitable, it was nicely profitable. Because the way I trade, I don't really shoot for 75 and 100 pip trades. I'm usually looking for 5 or 10, maybe 20 or 30 pips. And sometimes I get those 100 pip or 200 pip trades, and I just say, thank you, Jesus, because I never expect them to be that big. Because I know how Forex goes, right? And I do add profit stops on my trades, so most of my trades will get profit stopped out before they hit the profit target. And that's okay, because I don't care. Because over the years, I've made a whole lot more money on little trades than most people have made off of the big trades that they've been successful on. Little profits add up, especially when you're not taking losses. Okay? So what's next, Aaron?
So Nadine would like to ask a question about sizing appropriate to the EA.
Okay. So now on the EA has been programmed to size itself. Okay? So let me bring up oh, this is going to be hard. I'm not sure I have any accounts here that have a sec. That have the EA. I am in the middle of changing computers. I bought a new computer a couple of weeks ago, and I'm still trying to move all of my stuff over. I know how I can show it to you. I'll open this VPN server thing, show it to you there.
While you're looking for it, let me just read his question word for word.
Okay.
He says, so with the Magic EA, would you use that same formula, $1,000 per mini lot, or is that set up a little bit differently? I would want to do the Magic EA exactly how Mindy does hers. I have the demo in the middle of setting it up.
Okay. Here's the thing. The EA works on a very similar principle, but it does allow more trades than what you would allow if you were going to do it trade manually. So instead of allowing, $1,000 for each mini lot trade that you make manually, the EA is really, really good at managing the trades and making sure that they're getting offset every time. So the EA allows more trades than on $10,000 than what you would do manually. Okay? And so here's how the EA works. When you install the EA, you will see that each chart, the EA has to be installed on each chart that you want to use it on. And they have these little dashboard boxes, that's what I call them. When the EA is on the chart, you have this dashboard box. It tells you the set file that you're using. It tells you if there's any currently open positions, and it tells you what the current spread is, right? But one of these boxes is different than the others, right? Which one of these pictures is different than the other? We're going back to preschool stuff here. But one is different, and it's blue or green, whatever color this is, instead of being gray. This is like the master EA. And all these other EAs are subordinate to this one. But in this EA that is green, what we've done is we have utilized in the properties for this pair something called the Account Risk Manager. Now, the Account Risk Manager defines how many trades the account can take at any given time and be at risk. A trade is at risk if it does not have a profit stop on it or if it is not hedged. But this controls how many lots can be at risk at any one time, and it also controls how ugly the open positions can get before the EA is going to turn itself off. Okay, so what this is doing, line 4 of the EA, says universal maximum lots at risk, and then it wants to know your limit. And this is an account that's trading little micro lot trades. So I said I don't want more than 2 mini lots at risk at any given time. And then I've also said, or I don't want more than 20% of my equity or my balance to be being used to ride trades that are negative at any one time. So if either one of these conditions is met, the EA will stop making new trades that could go at risk, but it will continue to manage and hedge the ones that are already there if they are not hedged yet. So it does it all automatically. And then the trade size is right down here on where is it? Lot size, right here. We have told the EA what size trades to use, and we've told it to use 1 micro lot trades. So every new trade that the EA puts in is going to be 1 micro lot in size. Okay, which is the same equivalent as if we were using 1 mini lot on a $10,000 account. But we're also telling the EA that it can make up to 20 of them instead of 10. See, if I was trading manually, I would limit myself to 10 micro lot trades on $1,000 or 10 mini lot trades on a $10,000 account. But on the EA, I'm saying double that, because the EA is not going to let anything slip off, right? It's going to make sure that you will never have a margin call, right? Because one of these two situations is going to stop any new trades from entering. And let's just say that it was the 20% that stopped it. Well, if the balance has $1,000 in it, we'll just round off and forget the 48. If it has $1,000 in it, and then I had a whole bunch of trades that were negative, and I had a $200 negative PL here, it's not going to let any more trades go in, but it's going to manage the ones that are there. Now, if they're not hedged yet, you could theoretically see the negative PL go up to $400, but by then every single thing in the account would be hedged. So your negative PL could go bigger, but it's not going to get anywhere near big enough to run out of usable margin and create a situation for a margin call. And that's the whole point. We don't mind using the funds that we put in our account to manage the trades that are ugly. We just want to make sure that we're managing the trades in a way that we're never going to run out of money to manage them with, because the negative PL in the account's going to get bigger, and then all the trades will come out and it'll get smaller. Occasionally you see a whole bunch of trades in your account where they're all positive at the same time, right? Now, that doesn't happen very often, but it does happen sometimes, right? But most of the time, you're going, oh my God, you got 3 trades and they're all ugly? Yeah, I do. You know, one of them went in on May 13th. It's been sitting in here for, 2 weeks? These other 2 went in on Friday. They just haven't had time to come off yet, right? So, and they might hedge. Who knows? They might hedge. But the thing about it is, what you see in the account, if we look at all of the history in the account, just a sec, let me make this window bigger. It's only been trading about a month, but let's scoot this over so you can see the profit column. None of these trades are making too much money, but who cares? They're getting stopped out for 2 or 3 or 4 pips, 5 pips, something like that. But you can see that the vast majority of the trades never hedge. Some of them do, but most of them don't, right? Now, this account, since I've been trading it, the most trades I think that I've seen in this particular account in the last month was, I don't know, maybe a chain of 10 or 15. But it's also been down to where it didn't have any any open trades at all in it several different times. Now, the last time would have been like May 12th, which was 2 Sundays ago. That was my birthday. That's why I remember. It was not last Sunday, but the Sunday prior. And this trade has been in here since May 13th, which would have been that Monday after Mother's Day, right? So sometimes trades stick around a long time. And this trade actually might have been hedged at some point during that time as well. And it might have bought off its hedge. Let's go see. This trade ends in 0794. So when we're looking at the all history and we sort them by hedges, we're going to look for one that ends in 0794. Let's go up to the hedges. Really, really, really hard for me to see this. Okay, here we go. So that trade, that original trade that we're looking at from May 13th, it has hedged one time. Okay? Now, what happened is when it created the hedge, see how the hedge closed for negative $1.59? But we'll also have a quick fixer trade down here too for that same trade. And we're looking for 0794. It's right here. The quick fixer made $2.37. The quick fixer bought off the hedge when the hedge was no longer necessary. And now the trade, the original trade, can go ahead and become profitable on its own, or it might hedge again and quick fix again. But we made money on the combination of the quick fix trade closing the hedge, so we don't care. We made $2.37 on the quick fixer. We lost, what did we say, $1 something, $1.59. So we made about 70 cents or something, which would be the equivalent of about $7 in a regular size account. This is a micro lot account, so it's playing for dimes, right? But we made a nice profit on the closure of the hedge when we no longer needed the hedge, right? If we need the hedge again, the EA will re-hedge this trade and do it again, right? So anyway, the numbers in the EA are programmed in a way that it's going to size everything appropriately for the account you're using. It's going to manage it appropriately, but it will be making more trades than what I would recommend that you make if you're trading manually. So did that answer your question? Good.
He says, yeah. And he also has a follow-up question on that, asking about, well, I'll just read it. How much money theoretically could be made on a $5,000 investment into the account, taking into account commissions, monthly fee for EA, and any other trade-related items?
Okay. So the thing about the EA is that it tries to replicate the strategy that I use manually, where it's looking for overreactive price action and it makes the trade and then manages the trade. Now, the EA is not as good at trading as I am, right? Because my accuracy when I'm trading manually, I get about 2 hedges out of every 1,000 trades that I make, which would be like my win ratio would be 99.99, okay, or 99.98%. That's when I trade manually, and that's what I teach people to do in my mentoring. The EA is a whole bunch of math equations that's trying to replicate what I do. It's not as good. The win ratio on the EA is about 80%. Okay, so 80 out of every 100 trades it takes do not hedge. Now, just because that ratio is 80%, it doesn't mean that we close 20% of the trades for a loss. We don't close any of the trades for a loss, because every time we close a trade, we're closing it for a profitable outcome, like I showed you here with the hedge and the quick fixer. The only difference is it takes longer. So sometimes you'll have a whole bunch of trades that are ugly and hedged. You haven't lost a dime. You might have money tied up over here. You're using the money in your account to make more money eventually. You know, sometimes it takes a couple of weeks for markets to kind of turn back around a little bit, but they always do, is the whole point. So anyway, what you can expect for the EA is that some days are going to be better than other days, because depending on how the price action is, some days the EA might make 40 or 50 trades and make 8 or 9% profit in the account in one day, right? But then you might have another day where it makes like 1 or 2 trades and makes tiny, you know, they both get stopped out for 2 pips. So, you know, it wouldn't even be a measurable percentage in the account. And other days you might have days where stuff gets stuck, like this, or even stuck and hedged, where you have money tied up. But over time, okay, like you can never install the EA on Monday and say, I want to have, 5% by Friday. You can't say that. But what we can say with some certainty is that over time, the EA is going to average about between 1/2 and 1% per day. So that means if you had it running for 2 months, it's probably going to be up between 20 and 40% in equity, right? So it's averaging 1/2 to 1% per trading day. But the thing is, until you have the overtime average, you might be unlucky enough to start trading the EA at a time like a couple of weeks ago when all of a sudden the pairs that had been range trading for months decided to trend. And so, you know, if you started trading it 2 weeks ago, you might be saying, that Mindy is a creep. I opened an account with $1,000 and now I've got 800 in equity, and I've got $200 sitting over here in negative PL, and you'll be cussing me up one side and down another. But if you just wait it out, be patient, it's all going to clear itself out. And eventually those trades that are now using the money that you put in the account to use to make more money are all going to come out profitable, and all of this negative PL flows right back into the equity. And then, maybe 2 months from now you're going, man, that Mindy is brilliant, because look at this, I've had this account open for 2 months and I'm already up 50%. But the thing is, we don't know from one day to the next what the market's going to offer, is the whole thing. Some days it offers great trades and lots of them, and other days all it offers is problems, because the EA is trying to use mathematical equations to replicate what I do. And the difference is, as a human, I'm smarter than a whole bunch of mathematical equations because I can see the technical indicators on the chart, which is what the EA is reading. And I can say, oh yeah, technically this is a great place for a trade. But I can also go as a human and read what's happening with the Brexit or with the situation with China and the trade deals and know that fundamentally there are issues that are going to negate the value of the input that's being input by the technical indicators. You know, as a human, we can do that because we're smart enough to be able to incorporate fundamental issues and technical issues. The EA is simply working on technical issues, but over time it should produce between 0.5 and 1% per day, which means that over the course of a year, the EA, you know, there's 225 trading days in a year. So by itself, if you leave the account open for a year, it should between double and quadruple somewhere. You know, if you started with $1,000, you'd have somewhere between $2,000 and $4,000 at the end of the year. But there's no, you know, I cannot guarantee that that will happen. But I've been using the EA for 1.5 years now, through all of its different stages of development, and that's kind of what it's been averaging over the 1.5 years. So did that answer your question? But I can't sell you the EA with any kind of guarantees, because as you know, with Forex, one of the other disclaimers that just is standard is past performance can never be assumed to be indicative of future performance. You know, but I've been trading for 20 years, and I think past performance is an indication of future performance. So I disagree with the disclaimer that I have to give every single day, right? But the thing is, you have to look at bigger picture situations. You can't say, last week the EA made 10%, and say, so this week it should make 10%. You can't say that. You know, just the same way you can't say, last week this sucker lost 20% in my account. Well, actually, it didn't lose anything if you didn't close the negative trades. You haven't lost a dime. It's just that you're using your funds to manage your trades while they're ugly until they become profitable. That's all there is to it, right? And it's just a matter of getting your mind wrapped around that idea that I haven't lost a dime in this account. I'm just using $14.48 of my money to manage these trades until they become profitable. I'll close them when they're profitable, not when they're at a loss. Okay, did that explain it? Okay, what's next?
So, a little while back, Paul had a question, and I think that the answer's probably pretty straightforward, but I wanted to let you talk about it a little bit.
Okay.
He said, so you don't go for a 1-to-1 profit to loss ratio, or any kind of profit to loss ratio, I assume is what he's kind of talking about.
That's correct. I don't. I never, the thing is, when you do that, when you say, okay, I want to make 10 pips on this trade, so I'm willing to sacrifice 5, you know, with a stop loss. So you're saying, I'm either going to make 10 or I'm going to lose 5. Well, we never know what the next price bar is going to be. We might have a good indication of where we think it should go, right? But one of the very first, most basic things I try to teach people is that you should never, ever, ever let a good trade go bad. Okay, so let's say that I want, my goal for some trade is 10 pips or 20 pips, 50 pips, doesn't matter, whatever. Everybody always has a profit target in mind. But a profit target is nothing more than a wish and a prayer. That's all it is, right? The price might go there and it might not. So if you get into a trade and the trade becomes profitable, who cares how much profit it is? If you go out there and protect that trade with a profit stop, what's your worst case scenario? You're going to make money. Might not be as much as you wanted, right? But let's just say that, let's go back and put another price line out here. And we'll just put it anywhere. It doesn't matter where we put it, right? But let's just say that we were doing a buy trade right here at 110.44. And we want that to make 25 pips. So that'd be 110.70-ish, right? Well, sure enough, the price, if you went in right here, it went straight up to, the 110.70 that you were looking for. You would have made your money. But what happens if you went in right here? Well, before it went up to 70, which was 30 pips, it came down to 02. So it lost 40 before it would have gone up to 30 that you were looking for, right? But so instead of putting a stop loss out here, if instead you had a hedge order sitting down here at 109.40, your trade would have gone ugly. It would not have hedged, and it would have gone profitable. But once it does go profitable, put a profit stop on it. When it's 5 or 6 pips profitable, add a 1 pip profit stop or a 2 pip. And what's your worst scenario? You made 2 pips. But if the price diddles around a little bit, you made 2 pips here and then goes down to here, you can put the trade in again and maybe at a much better spot than you had it the first time, right? But never let a good trade go bad. Add a profit stop. Keep your profit target out there wherever you want it to be. But as your trade continues to get more and more profitable, keep moving your profit stop up to protect more and more of the profit in the trade. Okay? Because your whole life in Forex will change when you stop taking losses and start using profit stops. Even if you get stopped out of every single trade you take for 2 pips, at the end of the day, you're still going to have made money. At the end of the week, you're still going to have made money. And at the end of the month, you still are going to have made money. Right? And that's the whole point. Maybe not as much as you wanted because none of your trades hit the profit target. But who cares? A lot of people hit their profit target like 1 out of every 3 times. But the problem is the other 2 times they hit their stop loss. So even when they make money, they haven't really made any. They've just paid themselves back from the losses that they took over and over before they had the trade that made it to the profit target. Does that make sense?
Paul also has a follow-up question there.
Okay. Is that the one about why do some traders not have hedging?
Yeah.
Okay, some brokers, mostly brokers in the United States, they're the only ones I know that don't allow hedging. It's because of the U.S. regulators and the rules that they implemented about 15 years ago, where honestly I would never trade in the United States because you cannot hedge your trades. they have something called the FIFO rule, which means first in, first out. So here's what happens with the FIFO rule. Okay, let's say that you did a buy trade, and this time, let's say that this price was coming down and you did a buy trade right here, right on this bar. Okay, and then the price took this big dump and your buy trade was super ugly, but you knew from all the technicals and everything else that it was time to do another buy trade. So let's say you got another buy trade in right down here, and then the price comes up to here and starts kind of fluttering, and you go, man, I want to take my profit off of this trade. And this was at 104.79, we'll call it 80, and the price is right here at 108.96. That's, what is that, 450 pips, something like that. Do you know in the United States you're not allowed to book the profit from this trade until you first take the loss from this trade? That's stupid. There's no reason for a rule like that, right? And most of the time it's not this dramatic. Most of the time, it's situations where they're forcing you to take a loss because this trade went in first before you can close this trade for a profit. That rule simply makes no sense. And so that's one downside for trading in the United States. The next downside is, let's say you have a $10,000 account. In the United States, the best leverage you can have is 50 to 1. Okay, that means that a one lot trade is going to cost you $2,000 to be in. Okay, well, if you just use $2,000 of your account to be in one trade, that means, and you have to leave some cushion in case that trade goes ugly, that means the most trades that you could even possibly be in might be 2 at any given time. But with that same $10,000, when I trade overseas with 400 or 500 to 1 leverage, and it only costs me $200 to be in a one lot trade, I can afford to be in 5 or 6 of them if I wanted to, right? So there's the other problem with trading in the United States. And then, of course, the third reason is because they will not allow you to hedge. So if you have a trade going ugly, you have absolutely no way to protect your account except to put a stop loss on the trade. So, those 3 reasons combined are why I tell everybody, do not trade under the U.S. rules. You will never be able to make a reasonable amount with your Forex trading. All of the rules are levied against the trader in the United States. So anyway, that's the only reason I know of that a trader would not use leverage, is because their broker's not allowing it. But the only brokers that I know that don't allow hedging are the ones in the United States. They're also the only ones that have the FIFO rule, and they're also the only ones that have the ridiculously low leverage. Well, now the UK does too. In fact, the UK took the leverage issue and made it even worse than what we have in the United States. Because on some pairs it's 50 to 1 leverage, on some it's 20 to 1, on some it's 30 to 1. It's all, everything's all depending on the pair that it is, which even makes less sense than what the US did. But in the UK, they can still hedge, and they don't have anything like a FIFO rule. They just screwed up the leverage situation. So, but anyway, I hope that answered that question. So, what's next? Oh, I see a question. Is a profit stop a trailing stop? No, but it can be. You can trail a profit stop. But a profit stop just means that it's a stop, like a stop loss, that's going to close the trade if the price backs up and touches it. But it's a profit stop because the trade will be closing for a profit, not a loss. But you can trail the profit stops, and what happens in the EA has an automatic stop trail situation built into it. So when the EA makes a trade, we'll just go back to the properties window. When the EA makes a trade, we tell it right in here somewhere if we want to use the profit stop. And so in this case, we'd be adding a stop of 2 pips when the trade is 4 pips profitable. And the very next thing is, do we want to trail it? And then from this point forward, as the trade got more profitable, the stop would move up 1 pip to protect 1 more pip of profit for every 1 pip that the price went up. And of course, when you're using the EA, all of these variables you can key in to be whatever you want them to be, right? You don't have to use the profit stop. You can actually use the profit stop as a stop loss if you want to. You just set it up a little different, but you could do that. But it also trails, so the trailing is not a problem. It also will automatically generate a profit target on every trade. See, these 3 trades, they all have profit targets on them. Now, if these trades hedge, the profit target will come off while the trade is hedged. And then when it's no longer hedged, like this one, it put the profit target back on, right? So the EA does all of this for you automatically, all of this trade management. It will also hedge the trade when you tell it to, right? It will also manage the fixer trade to whatever requirements you put in. Now, what I do when I sell people the EA is I send them a complete set of set files for each pair that I have found to be useful. That doesn't mean that you can't change them, but the thing is, see, every pair has its own set of parameters, and they can be quite different depending on what pair it is, right? So, but it's all, and I send these set files to you so that you have a starting place. And then the longer you use the EA and the more familiar you get with it, then you might want to change those parameter settings to suit your own trading style. And here again, Alan, if he's still out there, could tell you how he has used the EA for different, settings and things. So, but it's, you need to use the EA first for a month or so, just on a demo account. Just watch what it does to get a feel for what it's doing and how it's doing it before you go in and start trying to change everything. But you can change it to anything you want it to be. You have total control over how much risk you're willing to take in the account with the account risk manager that's controlled by just one of the charts. But on each pair, you can change the parameters to be anything that you want them to be. So you can make it easier or harder for the EA to enter trades in any pair, and every single pair can be managed completely different than every other pair. Okay?
Lenny has a question. It reads, is it mandatory to apply a profit stop on your fixer trade as soon as it becomes profitable by, let's say, 10 pips instead of just waiting to buy off the original and hedge?
Okay, what happens with that, what we've done in the EA is we've gone in and we've calculated when the best time to be to remove the hedge, right? So the quick fixer profit situation is down here somewhere. You'll have to pardon me. My vision is so bad that I can barely read what it says on these VPNs. See, I'm still over on that VPN server. But somewhere down here, can you see what I'm looking for, Aaron? I'm looking for when the quick fixer. Okay, here it is. Okay, you don't have to use the quick fixer if you don't want to. For one thing, you can turn it on or off. But what we're telling it here on line 38 is that we want to use it. So when a trade hedges, what happens is that hedge is going to go in immediately as soon as the EA can find a tick to put the hedge in on. So your hedge is going to be very close to 100 pips away from your original trade. It might vary by a couple of pips because when you're trading a live account, the broker has to find a tick to enter your trade. So sometimes that tick won't be spot on the 100 pips. It might fluctuate and it might be, a pip or two difference. But when the hedge goes in, the quick fixer makes 2 orders for the quick fixer, but they're OCO orders, meaning one will cancel the other. It puts one fixer order above the price of where the hedge entered and one order below the price of where the hedge entered. And those 2 orders are controlled right here. Now, once one of them picks up, the other one just disappears. But then, as the quick fixer gets profitable, we're telling the EA, right in this line, to add a stop on the quick fixer trade when it's of 13 pips, when it's 14 pips profitable. But then we're also telling it to close the hedge when the quick fixer is adding its profit stop. Okay, so when the quick fixer gets its profit stop, it's closing the hedge because the hedge is no longer necessary. And if the quick fixer continues to get more profitable, it has a trailing stop on it. So it's not going to get less profitable, but it could get more profitable. And I have had situations where the quick fixer bought off the hedge and then continued to get more profitable by 100 or more pips. Because I've had some quick fixer trades actually close sometimes for 120, 130 pips. Which is amazing when it happens because that's just like free money in your account. But usually that's not going to happen. Usually once it closes that hedge, the quick fixer is going to get stopped out relatively soon, within a pip or two. But it doesn't matter because it's served its purpose, because it's made more money than you lost on the hedge. That was the whole point of the quick fixer. But you can adjust those numbers right in here anytime you want to. But the quick fixers automatically have a trailing stop built into them. Did that answer the question?
The question was ideally for original and hedge done manually.
Okay, well, when you're doing it manually, okay, if you're trading manually and you have a hedged situation, when you add a third trade to the mix, because we don't want to take chances with that trade, if you're adding this quick fixer down here, like let's say you had this buy from this line here and it went 100 pips ugly and you had a sell like right in here somewhere, and then the price dropped way down here and you put in a quick fixer. Well, what you should do with this quick fixer, if you know you have a really good entry, then you should wait until this quick fixer is maybe 10 or 12 pips profitable, and then add a 2 pip profit stop to it, because it's probably not going to come down and stop you out for 2 pips. And then wait for it to get up to an area where it would be worth enough to buy out your whole problem with your original trade in the hedge, and then just add a profit stop to it right there, take off the other 2 trades, and let your quick fixer see if it can get more profitable on its own. But yes, when you're manually trading and you have a quick fixer, you do want to put a small profit stop on it, because if it's a situation where you're putting a quick fixer in here or here or here, we don't know if the price is going to go down or not. And if you have something that gets mildly profitable and it gets stopped out, it's probably going to give you a better opportunity to go in again anyway. So when you're doing it manually, yes, you absolutely want a profit stop on that quick fixer. The EA, on the other hand, does not put a profit stop on the quick fixer until it's at a situation where we know for a fact it can buy off the hedge for a profitable outcome. So there are differences there on how you trade that manually and how the EA is doing it. But what I suggest that people do is use the EA, but also trade manually. You can do both. Having the EA on here does not stop you from taking manual trades. But if the if the EA makes trades that you like, you might want to make another trade that's a little bigger. If it makes a trade that you're looking at the charts and you go, I wouldn't have made that trade. Well, most of the time when these trades enter, there's a few minutes in there where they will be mildly profitable, maybe not profitable enough to put in their profit stop. But if it's a trade that I'm looking at it and I'm going, nah, I don't want this trade, I just go over and close it manually when it's like a pip or 2 profitable. I don't let it go ugly at all, right? But the EA is not going to add a profit stop on these until the trade is usually 4, 5, or 6 pips, 7 pips profitable, and then it's going to add a profit stop of 3 or 4 or 5 pips. But sometimes we can just look at a trade and say, yeah, it might be 2 pips profitable right now, but it's got a much higher likelihood of going negative 20 before it gets positive by 6. And in those cases, I just close it out. Don't let it go ugly at all. And that's what I do when I enter manually too. If I'm taking manual trades, if I enter a trade, if it doesn't go my way within 5 or 10 minutes, I'm already disgusted with it. And if then it gets to be 1 or 2 pips profitable, I'll just close it right then. Because most of the trades, when I take them manually, within 15 minutes, they're usually 8 or 10 or more pips profitable. Because most of the trades I take manually might only go 1 or 2 pips negative at all before they go positive. But the thing is, every single trade you take will start off negative because of the spread, right? Doesn't matter what trade you take, doesn't matter if it's a buy or a sell. Every single trade that you initiate will start off negative by 1 or 2 pips, sometimes more, depending on whatever the spread is at the time. Okay? Is anybody here? Go ahead.
Nadine had a quick question. He asked, is a profit stop the same thing that is also referred to as a take profit?
No. A take profit is a profit target. See, in your MetaTrader, you have 2 columns here in the middle. One is S/L, which officially means stop loss, and the other was TP, which means take profit. So if you're trading manually and you put in a trade, you can click on the take profit column anytime you want to, and you can add a profit target. So this trade has a profit target on it because the EA built this trade, and the EA starts every trade with a profit target every time, right? Doesn't mean it's going to get hit, but what I do is I still have profit targets on my trades, but most of the, excuse me, I have the hiccups. Most of the trades that I make will hit their profit stop. See, I don't add a stop loss on my trades. I only add a stop when I'm going to be protecting profit. So I call them profit stops, but it's this same column. Now, when you look at the history on this account, well, you can see that most of the time I get stopped out of my trades. But you can also see that they're all stopping out for profits, just tiny profits, because this is a tiny account, right? So this would be about 4.5, 5 pips here. This would be about 3 pips, 1, 2 pips there. A lot of them stop out for about 2 pips, right? Because when the trades get to be 4 or 5 pips profitable, I'm adding a 2 pip profit stop, because I'm not going to let a good trade go bad. Because if it starts going bad, it might go bad enough to hedge, right? But you can also see that, even though most of my trades stop out, let's put these in order so that you can see how they went in. This is like from the get-go, right? And usually the first couple of weeks, things are going to go great. You're not going to have anything hedging. And a couple of weeks into it, you'll start having a couple of trades that go negative enough to hedge and quick fix. So here was a quick fixer that closed this hedge, right? The quick fixer made $3.36. The hedge lost $1.60. But who cares? We still made $1.50 or something in there. And then we had a whole bunch more trades that just came out as they should. Here was another situation where the quick fixer, okay, the hedge went in, the quick fixer went in, the quick fixer bought off the hedge, the quick fixer made $1, the hedge lost 18 cents. Doesn't matter, it's a profitable outcome at a time when the original trade no longer needed to be hedged because it wasn't 100 pips ago. But anyway, it's just the same scenario over and over and over and over again. The quick fixers are buying off the hedges. The quick fixers. Well, okay, this was a situation where we had a little hiccup in the EA. It's since been fixed. But what happened here is we had a move that right after the hedge went in, the market hit one of those interest rate announcements and moved 100 pips or so. And the programming in the EA was such that it did exactly what it was supposed to do. The only problem was the quick fixer opened way lower, 100 pips or so lower than where it was anticipated to have opened. And so we had a negative situation there. But that was very unusual, and we've since fixed the programming so that will never happen again. But most, this is what's supposed to happen. When you have a quick fixer closing a hedge, it's a positive outcome, always, and, or should always be. But every now and then there might be a hiccup where that doesn't work. But that situation that caused that one thing, that'll never happen again because we've now changed the programming so that it can't happen again. So, and that's the thing about, developing EAs. I put 20 years of experience into this EA, and I still, that was about 3 or 4 weeks ago, where it had that situation that I had not programmed for, right? Because it never occurred to me that I just might pick up a hedge 30 seconds before a news event that would cause the price on that pair to drop, 150 pips, right? But now we've added a few lines of programming into the EA that will never let that situation happen again. But there's very few. I tried to program this for essentially every situation I've ever seen in the 20 years I've been trading. And I've been trading full time, literally 24 hours a day for 20 years. I don't do anything but Forex trade. And on the weekends, I live and breathe Forex, even though the market's not open. But anyway, I probably have put more hours in Forex than any other human living, because I started trading it literally within the first year of when Forex trading became available to trade online. And I've done nothing else since then, because I think it's fun. And you'll think it's fun too. It's very addictive. Forex trading is very, very addictive. You can literally spend 24 hours a day the rest of your life learning and growing in your Forex knowledge. So do we have any more questions?
We don't have any more questions. I think that was all of them.
Okay. Well, okay. Now, one thing that I want to let you all know about, if you go back to my website, and if you want to trade with a foreign broker that I trust, okay, I have a link on my website right here where you can open an account with the foreign broker, okay, and they offer 500 to 1 leverage. They allow hedging, and they do not have the FIFO rules. Okay, now this is a broker called CoinX. There are several companies on the web called CoinX. So please come to this link to make sure that you get the right company called CoinX. Okay, because there's several brokers that go by the name of CoinX. And we had that same problem with the broker that we were using before, FinPro, because there were 3 different websites called FinPro Trading, and only one of them was the good broker. So anyway, make sure that you come to this link to get to the right one where you can open your account. But when you need help, I'm here to help you. And if you are interested in trying the EA, right, you can come to my Shop Now button, and I have all different ways that you can try the EA and try my mentoring program, right? So the thing is, if you want to buy the EA, what I do is anytime anybody buys a license to the EA, you automatically get a demo account license also. And I highly recommend that you demo account trade the EA for a month or 2 before you trade it in your live account. But if you buy a license, your license for your live account does not start until you're ready to start trading on your live account. So you can buy a license for your live account. You can have 1 or 2 or 3 demo accounts. I don't care how many you have. You can run those demo accounts for 2 or 3 months if you decide to, and then your live license would begin. So you're not going to be wasting your month of your license demo trading. Your live license doesn't start until you actually start trading on your live account. Until that time, you have all the free demo accounts that you want. because you might want to, there's a lot of valid reasons why you might want to run the EA on 2 or 3 demo accounts at the same time and trying different strategies or different time frames or whatever, and that's fine, right? Now, the other thing that I've added just yesterday is I added a different kind of license for people who have smaller accounts, and this is called a Micro Magic EA. This one is the Mindy's Magic EA. It really is for accounts of $5,000 or larger, and $10,000 would be preferable. Okay, but this Micro Magic is for accounts that would be the size of this one that started with like $1,000. Okay, now the Micro Magic account does not offer you the ability to adjust the size of the trades. The only option is that it's going to make all of the trades one micro lot in size. Okay, but I can offer it a lot cheaper. So anyway, this is a brand new license. I just had the programmer develop this past week. Okay, but for those of you who are trading really tiny accounts, this is a good way, because it doesn't pay to spend $100 a month on the EA if you're going to be trading it on $1,000 account, because you're only going to make maybe $100 or two, maybe $150 in the account in a month, right? So this license doesn't make any sense for small accounts. So anyway, that's something that I've just added. I just added that yesterday, but there's all kinds of stuff on my website. You can watch any of these videos if you need help on just kind of opening a demo account and getting it set up for trading. Watch these videos. If you'd like to try my month-to-month mentoring service for a month or two, I guarantee you it'll be worth your money. And if you can't afford to do that on an ongoing basis, that's fine. You can take the mentoring service for a month or two and quit. No harm, no foul. No hard feelings, right? But it probably would be worth everyone's time to take at least 1 month of mentoring, because I can teach you things that you would never learn anywhere else, and probably save you tens of thousands of dollars over your Forex career, just in 1 or 2 months of mentoring. Okay, so anyway, I guess that's our program for today, unless anybody has any more questions. And I'm not seeing any activity on the chat. Well, thank you, Nadine. And everybody needs a big thank you for Aaron, because my vision's so bad. If he wasn't reading me most of the questions, I wouldn't have been able to see them. So thanks, Aaron. I really appreciate you doing that. Okay, so what I'll do is, if you would like any follow-up information, go ahead and send me an email with your email address. Just go to this email me link on my website and shoot me an email, and I will add you to my mailing list. And that way, when I do other programs or I have new videos or whatever, I'll shoot you an email and let you know about that. Okay? So other than that, I just really appreciate everybody coming today, and I guess I'll talk to you again soon, and we'll just leave it there. So bye for now. Oh wait, I see it. Sean is here from Australia, and he got up at 3 a.m. so that he could join us. Thank you, Sean. Thank you for getting up in the middle of the night. So, okay, well, thanks everybody, and I'll see you again soon. Watch my website. I'll probably try to do more things like this again soon, okay? So, bye for now.